Hi, hello, and welcome to Money Series Advanced Session Part 1, suitable for audience with investment skills of beginners to intermediate. In this session, I will show you how to save some tax on capital gains. We'll be using two techniques, one tax harvesting, two loss harvesting. Before we get to the techniques, let's understand what are capital gains. These are applicable to all investment types like real estate, equity, debt funds, mutual funds, etc. Tax and loss harvesting techniques will be useful only for equity and mutual funds. There are two types of capital gains. There are short-term and long-term capital gains. Both are results of your stock or mutual fund sale, though treated differently for tax purposes. Let's see how they are taxed. Short-term capital gains are taxed at 15% for equity and for debt funds at the income tax slab rate. Long-term capital gains are taxed at 10% for equity and 20% for debt funds. Any equity held less than a year is short-term and equity held over a year is long-term. Any debt fund held less than 3 years is short-term and any debt funds held over 3 years is long-term. Let's understand capital gains through some examples. Let's keep it that you bought ABC construction shares 2 years ago for 1 lakh rupees. You sell it today for 2 lakhs, then your profit is long-term profit. In this case, your long-term capital gain will be 1 lakh rupees. You have to pay capital gains tax at 10% for equities and that will be 10,000 rupees. Okay. Assume you bought XY debt mutual funds 3 years ago for 2 lakhs and you sell it today for 3 lakhs. Then you are booking profit on a long-term basis. Your long-term capital gain will be 1 lakh rupees. You have to pay capital gain tax at 20% for debt funds and that will be 20,000. Okay, we understood capital gains and how they are taxed. Let's get on to tax saving techniques. Tax harvesting. In India, profits up to 1 lakh in long-term capital gains on equities are exempted. Any amount exceeding 1 lakh in capital gains are taxed at 10%. Many of us invest and wait for years to reap the benefits. If you have not sold any of your equity investments for this year, then you are losing your 1 lakh exemption benefits without claiming. In net, you are losing 10,000. Let's understand this through an example. Assume you bought DF Industries about 2 years ago for 5 lakhs and it is valued at 6 lakhs last year and its current price is about 9 lakhs. Last year you did not sell any investments and this year you sold DF Industries for 9 lakhs, then your profit will be 4 lakhs. First 1 lakh being exempted, you will have to pay capital gains tax for the remaining 3 lakhs at 10% and that will be 30,000. Let's see how to save some tax using this harvesting technique. Based on our example, you haven't sold and claimed any tax benefit last year. Instead, you could sell and repurchase DF Industries shares last year for 6 lakhs. Then your last year profit would be 1 lakh and that would be exempted completely, resulting in no tax for last year. Market picking up this year and you sell DF Industries for 9 lakhs, then your profit is 2 lakhs after first 1 lakh being exempted as your purchase price is 6 lakhs. After tax exempt, your capital gains tax at 10% will be 20,000. Instead of paying 30,000, you have paid only 20,000 as tax, saving 10,000. Loss harvesting, also called wash sale technique. Selling and repurchasing the same equity that is in a loss position to offset the profits made from selling other profitable equities. This method will be useful only when you have confidence on the loss-making equity that it will go up soon. For example, assume you bought ABC Construction's equity about 2 years ago for 1 lakh and you sell it today for 2 lakhs, then you are getting long-term profits because you are selling it after 1 year. Your long-term capital gain will be 1 lakh. You have to pay capital gains tax at 10% and that will be rupees 10,000. Assume you also bought XYZ Corporation equity about 2 years ago for 2 lakhs and it has come down to rupees 1 lakh. Now you are in a loss of 1 lakh rupees. This is called unrealized loss. You have a strong feeling that XYZ Corporation will go up next year and you wanted to be invested on it. But you also wanted to reduce your long-term capital gains that you made out of selling ABC Constructions. What you can do is sell XYZ Corporation at a loss and repurchase it immediately, which is called loss harvesting or wash sale. You have 1 lakh in profits by selling ABC Constructions and 1 lakh in loss by selling XYZ Corporation, resulting in no capital tax. This is how loss harvesting works. Thanks for watching. If you have liked this video, please subscribe and don't forget to click on bell icon for getting notifications. Thank you.